7,000%. Let me say that number again slowly because it deserves to be heard with full attention. 7,000%. That is not a misprint. That is not the fever dream of a fringe economist in a basement somewhere. That is the calculated, documented, historically grounded figure that emerges when serious monetary analysts apply the same revaluation mathematics that governments have used in past monetary resets to the current relationship between the paper money supply and the available silver that could be called upon to back it. 7,000% is what the numbers produce when you do the honest arithmetic. And before this conversation is over, you're going to understand exactly where that number comes from, why it is not as outlandish as it sounds, and, most importantly, what every person who holds gold and silver right now must do to be genuinely, completely, strategically positioned for the possibility that history is about to rhyme in the most dramatic way it has rhymed in over a century. I want to begin with a feeling, not a fact, a feeling. Think back to the first time you held a physical ounce of silver in your hand. Maybe it was a silver eagle, government minted, sharp-edged, brilliant. Maybe it was a simple round, unadorned, honest. Maybe it was a bar, heavy for its size and the way that silver always is, dense with a kind of material honesty that no paper instrument has ever replicated. Do you remember that feeling? The unexpected weight, the cool smoothness, the quiet, almost irrational sense of rightness, the feeling that this, whatever else was uncertain in the world, was real. That feeling was not sentiment. It was not nostalgia for a simpler time. It was your nervous system recognizing something that 6,000 years of human civilization have encoded into our collective understanding of what value is. Silver is real. And in a world that has been building its financial architecture on increasingly abstract foundations for over 50 years, real has a power that is only beginning to be fully appreciated. You felt that power the first time you held it. What we are going to talk about today is why the rest of the world is beginning to feel it too, and what that awakening means for every stacker, every holder, every person who had the clarity and the conviction to build a position before the recognition became mainstream. This is the moment you built for. Let's make sure you are ready for it in every dimension. To understand where the 7,000% figure comes from, we need to go back, not far, just to 1933. Franklin Delano Roosevelt, in the depths of the Great Depression, signed Executive Order 6102, which required American citizens to surrender their privately held gold to the Federal Reserve in exchange for paper dollars at the then fixed rate of $20.67 per ounce. Most Americans complied. Some did not. And then, once the government had accumulated the gold it needed, Roosevelt revalued gold, overnight by executive order, from $20.67 per ounce to $35 per ounce, a revaluation of approximately 69% in a single administrative act. The people who had kept their gold, and the ones who had quietly, stubbornly refused to surrender it, saw the purchasing power of their holdings increase substantially in a single day. The people who had complied, who had handed in their gold for paper dollars, received nothing from that revaluation. They had traded real for abstract at exactly the wrong moment, and the abstract did not appreciate with the real when the reset came. This is a documented, established, indisputable piece of American financial history. It is not a conspiracy theory. It is in the public record, in the congressional archives, in every serious monetary history book ever written. And it is deeply relevant to right now, because the conditions that preceded Roosevelt's gold revaluation, a monetary system under extreme stress, a government carrying debt it could not service in real terms, an economy in need of inflationary relief, a population that had been conditioned to trust paper over metal, those conditions exist today in a form that is, by every measurable metric, more extreme than they were in 1933. Now extend that logic to silver. Silver was demonetized, officially removed from its monetary role over the course of the 20th century, culminating in the elimination of silver certificates and the last silver coins from American circulation in the 1960s. But demonetization is a policy decision, not a law of physics. Policies can be reversed, monetary systems can be restructured. And when a monetary system reaches the level of stress that the current global system is reaching, when the debt cannot be repaid in real terms, when the currency cannot be trusted to hold its value, when the institutional credibility that keeps paper money functioning begins to crack, the question of what backs the new system, whatever form that system takes, becomes unavoidable. The 7,000% figure emerges from analysts who have done the calculation of what silver's price would need to be if it were to back even a fraction of the current global money supply at a ratio consistent with historical monetary norms. It emerges from the comparison between the above-ground silver available for monetary purposes and the paper claims that theoretically stand behind it. It is not a certainty. It is a mathematical possibility, one end of a scenario range that runs from significant appreciation to something genuinely historic. And the fact that serious, credentialed, institutionally respected economists are willing to put that number in print and defend it publicly tells you something important about the analytical foundation beneath it. Let me tell you about a man who understood monetary revaluation at a level that most people never reach, and who built a fortune, not despite that understanding, but because of it. His name is Andrew Maguire, and he spent years as a metals trader in London before becoming one of the most prominent whistleblowers in the history of silver market manipulation, a figure who took extraordinary personal and professional risk to expose practices in the silver futures market that he believed were suppressing the metal's price below its true market value. Whether you accept every element of his analysis or not, the core of what Maguire has spent years arguing is supported by an increasingly mainstream body of evidence that silver has been systematically undervalued relative to its fundamental supply and demand dynamics, and that the unwinding of that undervaluation, when it comes, however it comes, will be one of the most significant price events in commodity market history. Maguire's story is not just about markets. It is about the courage that honest analysis demands. He saw something clearly. He said it publicly at significant personal cost. He continued to say it through years of skepticism and dismissal, and the evidence that has continued to accumulate, the persistent supply deficits, the accelerating industrial demand, the central bank gold accumulation that validates the entire precious metals thesis, the gradual but unmistakable shift in how institutional investors are thinking about monetary metals, all of it has moved year by year in the direction of his analysis. The lesson for every stacker is not that Andrew Maguire is infallible. The lesson is that honest, rigorous, courageous analysis, the willingness to look at what the data actually says rather than what the consensus is comfortable with, is the foundation of every great investment thesis that has ever played out. And the investment thesis underlying silver right now, built on the bedrock of monetary history, supply and demand fundamentals, and the mathematical reality of global debt levels, is as rigorously supportable as any thesis in the history of precious metals investing. Now I want to talk about what every gold and silver stacker must do right now, not in a vague gesture toward the future way, but with a specific, actionable precision that the moment demands, because being positioned in silver and gold is not enough. Being correctly, completely, strategically positioned is what transforms a good instinct into a genuinely life-changing outcome. And there is a meaningful difference between those two states that most people in the precious metals community have never fully thought through. The first thing every stacker must do right now is audit their position with honest eyes. Not the eyes of pride in what has been built, though that pride is warranted, but the analytical eyes of someone who is preparing for a specific set of potential scenarios, rather than simply holding and hoping. What percentage of your total net worth is currently in physical precious metals? If the answer is less than 10%, you are underweight, relative to what most serious precious metals analysts consider a meaningful protective allocation. If the answer is more than 30 or 35%, you may have concentration risk that warrants a conversation about broader diversification, because even in the most bullish scenario for silver, the wise investor never has all of their wealth in any single asset class, however compelling the thesis. The sweet spot that experienced precious metals investors describe, the allocation range that provides genuine protection and meaningful upside participation without creating dangerous concentration, typically falls between 15 and 25% of net worth. If your current allocation is significantly below that range, the analysis we have been discussing today makes a compelling case for deliberate, structured accumulation to close that gap. If you are at or above that range, the most important work is not adding more metal. It is ensuring that what you have is properly secured, properly insured, properly structured within your overall estate, and properly diversified across both silver and gold in proportions that reflect your specific financial situation and time horizon. The second thing every stacker must do right now is understand the difference between their silver and gold holdings in terms of function. They are not the same asset. They behave differently in different monetary scenarios, and understanding those differences allows you to position deliberately rather than indiscriminately. Gold is primarily a monetary metal. Its value is overwhelmingly determined by its role as a store of value, a reserve asset, a monetary anchor. Its industrial demand is relatively modest compared to its monetary demand. In a scenario of general monetary distress, currency crisis, sovereign debt stress, broad loss of institutional confidence, gold tends to be the first mover and the most immediately recognized safe haven. Silver shares gold's monetary heritage, but adds an industrial demand dimension that gold does not have. In a monetary crisis, silver participates in gold's monetary revaluation. But silver also benefits from the structural supply-demand imbalance driven by solar, electric vehicles, advanced electronics, and medical technology, a dimension of demand that gold entirely lacks. This means that silver, in the right scenario, has the potential to outperform gold dramatically. to close the gold to silver ratio that has widened to historically aberrant levels and return, perhaps not to its ancient mean of 15 to 1, but to something significantly narrower than the 70, 80, 90 to 1 that the ratio has reached in recent years. Every point by which that ratio narrows represents significant percentage outperformance of silver relative to gold. The practical implication is this: gold is your stability anchor. Silver is your high conviction upside position. If you're not currently holding both, now is the time to understand why both belong in the portfolio of a serious precious metals investor, and to build toward the allocation in each that reflects that understanding. The third thing every stacker must do right now is think carefully about the specific forms in which their precious metals are held. Not all silver is the same, not all gold is the same, and the distinctions matter enormously in the scenarios we have been discussing. Physical possession, metal that you personally hold, that is in your hands or in a fully allocated, audited private vault where you have direct legal title to specific numbered bars and coins, is fundamentally different from paper silver or paper gold. ETFs, futures contracts, pooled accounts, unallocated positions, these instruments give you exposure to the price movements of precious metals, but they do not give you the thing itself. And in a scenario of genuine monetary stress, the exact scenario in which your precious metals position is supposed to protect you most, the distinction between owning the metal and owning a claim on the metal may become the most important financial distinction in your life. There is a principle in precious metals investing that has been stated many times, in many ways, by many serious investors, and that I want to state here as clearly as possible. If you do not hold it, you do not own it. Your silver is not real silver if it exists only as a number in a digital account somewhere. It is a promise, a paper claim on metal that may or may not be there when the claim is called upon. The history of financial markets contains multiple instances of paper precious metals instruments that failed to deliver, that were, in various ways, not fully backed by the physical metal they claim to represent. In a normal market environment, these failures are manageable. In a crisis environment, precisely when you most need your precious metals to function as a genuine alternative to the failing system, they can be catastrophic. Every stacker should know, with specificity, how much of their precious metals position exists in physical form that they personally control, how much exists in allocated storage at facilities with verifiable audit trails, and how much exists in paper instruments that carry counterparty risk. The first two categories represent genuine precious metals ownership. The third represents something that, while useful for trading and price exposure, is not the same kind of asset and should not be counted as part of your protective hard asset allocation. If a meaningful portion of your precious metals exposure is in paper instruments, the action item right now is clear. Increase the physical, decrease the paper. Move in the direction of genuine ownership. Do it thoughtfully, do it at a pace that makes financial sense, but do it. The integrity of your position depends on it. Let me tell you a story about preparation meeting opportunity, because this is ultimately what everything we are discussing comes down to. In the mid-1970s, a small group of investors recognized that gold, which had been fixed at $35 an ounce under the Bretton Woods system until Nixon severed that link in 1971, was dramatically undervalued in a world where the money supply had expanded far beyond what the old fixed price reflected. They began accumulating, quietly, patiently, in the face of skepticism from mainstream financial advisors who told them that gold was a barbarous relic, that the modern financial system had evolved beyond the need for monetary metals, that the future was in equities and bonds and the sophisticated instruments of contemporary finance. They accumulated anyway, through the mid-1970s, through the volatility, through the corrections that periodically made it look like the gold thesis was wrong. And then, in 1979 and 1980, the recognition came. In a compressed, dramatic, staggering wave of buying that took gold from roughly $180 an ounce in early 1978 to over $850 in January of 1980, a move of nearly 400% in less than 2 years. The people who had accumulated patiently through the skepticism saw the value of their position multiply in a time frame that seemed impossible until it happened. The people who tried to buy into the move after it was already underway paid the price of being late. Some bought near the top and did not see those prices again for over 20 years. The lesson is not that a similar move is guaranteed in silver right now. The lesson is about the anatomy of a major revaluation. It builds quietly, it is dismissed, it accelerates, and then it compresses. It makes its most dramatic moves in a relatively short window. The people who are positioned before the compression benefit enormously. The people who recognize the opportunity after the compression has already happened wish, with a painful specificity, that they had started earlier. Right now, you are in the building phase. You are in the patience phase. You are potentially in the last phase before the recognition becomes impossible to ignore. That is a remarkable place to be. And it demands that you be as prepared as possible. not just in terms of how much you own, but in terms of how it is held, how it is structured, and how clearly you understand the thesis that will allow you to hold through whatever volatility precedes the full recognition. The fourth thing every stacker must do right now is develop what I call a revaluation plan. Not just an accumulation plan, a revaluation plan. Because there's a question that very few people who hold precious metals have ever honestly sat down and answered: what will you do when this works? What happens when the thesis plays out? When silver moves dramatically, when the purchasing power of your position has multiplied in ways that seemed implausible when you were building it? Do you have a clear, written, emotionally honest plan for how you will respond to that scenario? This question matters more than most people realize, because the greatest risk for a precious metals investor is not that the thesis fails. The greatest risk is that the thesis succeeds dramatically, and that the investor, in the emotional intensity of a rapid, significant price move, makes decisions that undermine the benefit they worked so hard to build. History is full of investors who accumulated an asset patiently, watched it appreciate dramatically, panicked out of the position too early, and watched the asset continue to appreciate without them. History is equally full of investors who held too long, who confused their conviction about the asset's long-term value with a belief that they should never, in any scenario, reduce their position, and who subsequently watched a significant portion of their gains evaporate in a correction before they acted. A revaluation plan is the antidote to both of these errors. It is a document, simple, honest, specific, that you write before the move happens, when your thinking is calm and rational and not distorted by the adrenaline of watching the price chart move in your favor. The plan answers three questions. First, at what price or valuation level does it make sense to begin reducing my precious metals allocation and redeploying into other asset classes, real estate, productive businesses, dividend-yielding equities that become relatively more attractive as precious metals become relatively more expensive? Second, what is my core holding, the minimum position I will maintain regardless of price, as a permanent component of my financial architecture? And why? Third, what will I do with the capital I reallocate? Where does it go? What does it build? These are not comfortable questions to answer before you need to, which is precisely why most people never answer them. And the people who don't are the people who, at the moment of maximum opportunity, are making decisions under emotional duress, rather than from the calm clarity of a plan they made when thinking was easy. Write your plan. Now, before you need it. It is the most important document in your precious metals strategy. I want to take a step back now from the tactical and the strategic and speak to something that sits underneath all of it, because the most enduring financial decisions I have ever observed in people are not made from analysis alone. They are made from a deep clarity about what the money is actually for. And I think every person who has built a meaningful precious metals position deserves to sit with that question, especially in a moment like this one, when the possibility of significant financial transformation is beginning to feel genuinely real rather than hypothetically distant. What is your silver for? What is your gold for? Not in the investment sense. What assets will you rotate into when you take gains? But in the life sense, what does financial security at a significantly higher level than you currently have look like for you? What does it make possible that is currently impossible? What fear does it eliminate that is currently a quiet background presence in your life? What choice does it give you that you currently don't have? Those questions, answered honestly with the specificity of a person who has actually thought about their life rather than just their portfolio, are the fuel that keeps the conviction alive through the inevitable volatility and uncertainty that precede any major financial transformation. The investors who build the greatest wealth are not the most technically sophisticated. They are the ones with the deepest, most personal, most emotionally grounded understanding of why they are doing what they are doing. The mother who is building a silver position so that no economic disruption can threaten her children's future. The man who watched his father lose everything in a currency crisis and decided, with quiet ferocity, that the same thing would never happen to his family. The couple who dreamed of a life of genuine freedom, not just financial adequacy, but freedom from the constant low-grade anxiety of financial fragility, and discovered in precious metals a path toward building the foundation that freedom requires. These are the investors who hold through corrections, who accumulate through doubt, who are positioned completely when the recognition arrives, because they know, with the certainty of the deeply personal, exactly what they are building and why. Your silver is more than silver. Your gold is more than gold. They are the physical embodiment of a decision you made about the kind of life you are going to build and the kind of person you are going to be. Hold that knowledge alongside the metal. It is the most important thing you own. Let me bring this home with a specific concrete action list that I want you to carry from this video into your week. Not vague intentions, but real tasks with real timelines. This is what every gold and silver stacker must do right now, collected and distilled into a sequence you can begin today. In the next 24 hours, review your current allocation. calculate the percentage of your total net worth that is in physical precious metals. Note how much is in silver versus gold. Note how much is in physical possession versus paper instruments. Have a clear, honest picture of where you stand. In the next 72 hours, address the most urgent gaps. If you have a significant portion of your precious metals exposure in paper instruments, identify the steps to begin converting to physical. If your gold to silver allocation is significantly imbalanced, all silver and no gold or all gold and no silver, research the rebalancing that would give you both the monetary stability anchor and the high conviction upside exposure that a complete precious metal strategy requires. In the next week, review your security and legal structure. Is your physical silver and gold adequately secured? Is it insured at its current market value? Is your estate planning up to date? Do your heirs know where it is and how to access it through legal instruments that make that access clear and uncomplicated? These are not exciting tasks. They are the completion of everything you have built. In the next 30 days, write your revaluation plan. The document I described earlier, your thresholds, your core holding, your redeployment strategy. Set aside 2 hours, find a quiet place, think honestly and write specifically. It is the most leveraged 2 hours you will spend this month. And ongoing, from this day forward, continue to accumulate. Whatever your current position, the analysis points to more runway ahead, not less. Dollar cost average. Buy consistently. Let time and conviction and the structural dynamics of the market do the work that patient accumulation always does for the investor who understands what they own and why. We are living at a moment in monetary history that will be written about, analyzed, and debated for generations. The convergence of forces, the debt levels, the monetary expansion, the de-dollarization, the industrial demand transformation in silver, the central bank gold accumulation, the geopolitical fragmentation, is producing conditions that have no precise modern precedent. And in conditions without precedent, the assets with the deepest precedent, the assets that have functioned as stores of value across every previous disruption in human history, have a claim on investor attention that no sophisticated financial argument can fully dismiss. You understood this before most people did. You acted on it when it was uncomfortable. You built something real in a world of abstractions, and you held it with the patience that real conviction requires. That is not luck. That is not accident. It is the result of serious thinking seriously applied, of honest analysis honestly executed, of the quiet courage to be early in a world that rewards those who are early and punishes those who wait until the signal is obvious. The 7,000% figure is a possibility, not a promise, but even a fraction of that mathematical potential, even a revaluation that represents a small portion of what the honest arithmetic supports, would be transformative for anyone positioned in silver right now. The question is not whether the fundamentals support it. They do. The question is only what form the recognition takes and how long it unfolds. And the answer to that question, the one that determines whether you benefit fully from what you have built, is determined entirely by how prepared, how structured, how strategically positioned you are when the recognition arrives. Be completely ready. That is your assignment. That is the work of this week, and the weeks that follow, and the months ahead. Be so completely, thoroughly, intelligently positioned that when this unfolds in whatever form it takes, your response is not scrambling or hesitation or emotional reaction. Your response is the calm, confident execution of a plan you made in advance, from a position of genuine preparation as the person who saw it clearly and acted accordingly. That person is you. You have already proven it. Now finish the work. I want to ask for 3 things before you go, and I want to mean each of them genuinely. The first is a like, not as a metric, but as a signal. A signal to this platform that honest, grounded, serious financial conversation, the kind that respects your intelligence and your capacity to engage with complex ideas, is what you want more of. Your like changes what gets recommended. It changes who finds this conversation. It extends the reach of something that might genuinely change someone's financial trajectory. One tap. Real consequence. The second is a subscription. Because this story is not finished, the monetary dynamics we have discussed are active and evolving. The silver supply situation is developing week by week. The policy decisions that will shape the next chapter of this story are being made right now in rooms that most people will never enter. I will continue to track all of it with the same honesty and depth and respect for your intelligence that this conversation has modeled. Subscribe so that nothing critical arrives without you having the full context to understand it. And the third is a share with one person. The stacker who has been holding their position but has never thought through the revaluation plan. The friend who has been skeptical but whose mind is open. The family member who trusts you and who deserves to hear, from a voice they may find accessible, what is happening in the monetary world right now and what it means for the financial decisions they are making or not making. One share, one conversation, one potentially life-changing introduction to ideas that you now carry clearly. The number is 7,000%. The homework is yours. The window is open. Go build.